I'm going to share with you a covered call trade I made using an ETF that offers 2 times leverage Apple stock at a fraction of the price. You know Apple, right? The $3 trillion company? It's currently trading around $230 per share, which means in order for me to sell a covered call, I'd have to own 100 shares, which would cost me $23,000. But the ETF that tracks Apple shares is trading right around $26 per share, which means it makes it a lot more affordable for me since 100 shares would only cost me $2,600. Be sure to stick around and watch this entire video. I'm going to share with you the profitability analysis, how to read the chart to make sure it's the right time to make the covered call trade, and how to submit the trade so I can actually make the money from this opportunity. Did you know that you can join my community of options traders for free? I host a community of options traders just like you and me, where we share tips, tricks, hints, and secrets about options trading. Not only do we share information on the community posts, but I've got a classroom that's filled with information and data. So head on over to school.com/simpleoptiontrading. I'll leave a link in the description down below. In my portfolio, I hold 100 shares of AAPU, which is an ETF. This is a 2 times leverage exchange traded fund that follows shares of Apple stock. So as the price of Apple shares move up and down, this ETF, because it's 2 times leverage, will move twice as much. So think of it like this. If Apple shares move up 1%, well then shares of the AAPU ETF will move up 2%. But by that same token, if Apple shares drop 5%, then AAPU will drop 10%. So as you can see, this 2 times leveraging makes the shares more volatile. But as an options trader, I like that because the higher volatility will usually coincide with higher premiums. So before we actually submit an option trade, we need to perform an analysis to make sure that it makes sense from a profitability standpoint. So I've got my covered call analyzer up on the screen. Let's go ahead and plug the numbers in and see if this trade actually makes sense from a profitability standpoint. So today's date is August the 8th, and we're using symbol AAPU. And for the expiration date, I'm going to go roughly 1 week out. So that's August the 15th. And for the strike price, my initial look at this, I'm going to be choosing the $27 strike price. And I'm going to specify 60 cents per share as the premium amount that I want to receive. Now my cost basis for the 100 shares of AAPU that I own is $21.49. Now let's run through the analysis. Now let's go ahead and run through the numbers. We can see that I'm going to be selling a covered call for stock symbol AAPU. Now the current market price is $26.67, and because I have 100 shares, that allows me to sell 1 option contract. Now today's price, the current market price, $2,667. Now remember, I specified an expiration date of August the 15th, which makes the length of this option contract 6 days. And it's 6 days because we take today, the current trading day, and then the 5 trading days from next week, so we get 6 trading days. And I specified the $27 option strike price with a 60 cent per share premium. Now, based off of my cost basis of $21.49, if this option contract gets exercised, I'll have to have my shares assigned to the buyer, but in return, I'll receive payment for those shares in the amount of $27 per share. So that price appreciation of $27 per share that I receive versus the $21.49 that I paid originally for those shares, my cost basis, that difference is going to be $551. So that's profit to me. And the $60 that I received initially for selling the option contract, that premium payment, that represents a 2.79% profit based off of my initial cost for those shares. Now, if this option contract gets exercised, I'll receive payment for my shares that gives me a profit of $551. And when I add that to the premium amount that I received, the $60 initially when I sold the option contract, my total maximum profitability from this trade could be $611, which represents a total maximum profitability of 28.43%. So this trade makes sense to me after doing my analysis. So we can see that this particular trade can be profitable for me. But now let's take a look at the chart and figure out what motivated me, or what's my why, for actually thinking about selling a covered call using my shares of AAPU. So in my portfolio, I own 100 shares of an ETF, that's exchange traded fund, called AAPU. Now this AAPU is an ETF that tracks Apple stock. So if you're familiar with Apple, the corporation, and their symbol AAPU, this is a 2 times leverage ETF, which means every time that Apple stock goes up or down, say Apple goes up 1%, well then AAPU, because it's 2 times leverage, will go up 2%. And then every time Apple falls, let's say it dips 5%, well then this ETF that's 2 times leverage will fall 10%. So it has the characteristics of Apple, but at twice the leverage, right? So you got to be careful here because as Apple moves up and down, this ETF will move up and down, but twice as much. But as option traders, we like the volatility because that's one of the ways that we are able to gain higher level premiums. So I've got a daily chart on the screen here you can see for AAPU, and it goes back till roughly April of this year. So we're looking at roughly 3 months worth of data. What I've noticed is, so let me just talk real quickly here. So the candlesticks obviously are representative of the price as it trades during the day, right? So a green candlestick means that the price finished or ended higher than where it started. And then a red candlestick means that the ending price finished below the opening price. Every candlestick equals 1 day. And as we can see here, I've kind of mapped out where the highs and lows are, and I've actually marked what are called the support and resistance line. So the support line, which is this line in pink, that's where the stock price tends to settle, right? So it tends to hit that support level, and then it has a hard time dropping below it. So it's kind of a support line there. So it supports the price. And the purple line up at the top, that's called the resistance line. And this is where the stock price reaches higher and has a hard time pushing through that level. So it tends to bounce off of the resistance line and come back down. And as the price hits the support line, it'll bounce off the support line and go back up. And as I look at this chart, I notice that AAPU has been trading in this range between the support and resistance lines. You'll notice that the majority of the candlesticks fall within this area. Now, within the last 2 days, actually Thursday, August the 7th, which is yesterday, and today, August the 8th, we see that the stock price has gapped up appreciably. In fact, so much so that AAPU is now trading at $26.96, whereas just a few days earlier, it was trading in the $23 to $24 range. Now, one of the things we like to do as option traders whenever we sell covered calls is to sell on green days, and this is definitely a green day. One of the reasons we like that is because we're able to capture more premium. So as the stock price goes up, the premium value also goes up, which is profitable for us, right? That's a good thing. And in this particular case, I noticed with the gap up in price, I've decided to sell my covered call using the 100 shares of AAPU that I have because I believe that this price, because it did gap up and it's so much higher than where it's traded in the past, and fundamentally things haven't changed that much, I think that this price will peter out somewhere between the $27 and $28 range. And then it's going to go through a correction where the price consolidates and drops back down to maybe, say, the $24 level. So come back to this resistance line. So now that I've showed you on the chart, maybe now you have a better understanding of what I'm thinking, right? So I believe that the share price will go up, gone past the resistance level. In fact, it's gone so high that I think in the future, this price is going to drop back down. Now, by picking a strike price that's up at this level, I believe that within the 1 week expiration that I'm choosing, the price will drop back down. The option will expire worthless. I'll get to keep my shares plus all the premium I collected. But what happens if the share price actually stays that high or exceeds my strike price? Well, then my shares will get assigned. And I'm actually okay with that. And as an option trader, we have to think about that whenever we sell a covered call, that there's always a possibility that the option will get exercised and our shares will get assigned to the buyer. And as a result, I'll make maximum profit because not only will I get paid the premium that I collected from the beginning when I sold the covered call option contract, but I'm also going to collect the payment for my shares and capture that price appreciation. That's the difference between the strike price, which is the amount of money I receive for selling my shares, and my actual cost basis, the price that I paid for those shares. So having an option contract get exercised isn't necessarily a bad thing as long as I'm okay giving up my shares and having them assigned to the buyer. It's a way for me to make maximum profit on the trade. So I own 100 shares of the ETF AAPU, which tracks along with Apple. And I'm considering of using my shares to sell a covered call. I performed a profitability analysis and I like the outcome and the potential profit that I can make from selling this covered call. And we can see from the chart that the conditions are favorable for me to do so at this time. So let's jump over to my trading platform and submit this order. So here we can see the ETF AAPU on my trading platform in my brokerage account. I own 100 shares with an average cost of $21.49 per share. So I'm going to submit my order for a covered call by pressing trade and then trade options. And now I'm going to select the August 15th expiration date. So that's 1 week away. And I'm selling a covered call. Now let's use the strike price of $27 and let's take a look at the details for this option contract. We can see that the delta is 0.38, which is a little bit higher than what I normally do. But like I said, I'm okay if my shares get called away and I'm paid for my share. Open interest is okay. There's 306 and the bid ask is get a nice spread. And I'm going to ask for 60 cents per share as the premium payment. So I'm going to specify one contract with 60 cents as my option premium. And here you can see I'm agreeing to sell 100 shares of AAPU at $27 per share. Now that's my strike price on or before August 15th. That's the expiration date. So I'll go ahead and submit my order. My order gets received and it's in the queue now. We'll have to wait and see if this order actually gets filled. Hey, so really good news. My option order did get filled. So here's the transaction. You can see that I'm selling a covered call for a symbol AAPU with a $27 strike price and an expiration date of August 15th. Now I submitted my order on August the 8th at 9:18 a.m. And my order got filled later that morning at 9:26 a.m. So about 8 minutes after I submitted my order, the order got filled. Now I specified a premium price of 60 cents per share. So when my order got filled, I received a total premium payment of $60. And that money's mine to keep forever, no matter what happens with the option contract. So if the option contract gets exercised, I keep the $60. Or if the option contract expires worthless, I still keep the $60. That's profit in my pocket. Hey, and let's not forget, profit in my pocket also means the tax man wants his share of the cut. So for me, I always take 25% off the top and set that aside in a dividend-paying ETF so I can profit while this money sits on the sidelines waiting for the end of the year to come so I can pay my taxes. Here's a quick update on my covered call mini course that'll be released later this month in August. If you're brand new to covered call options trading, then this course is for you. Or if you're an early beginner to selling covered call options, well then this course is for you. If you're curious about learning how to sell covered call options so that you can generate an income, well then this course is for you. This is my quick start guide to selling covered call options that takes students from zero to options trader. Be sure to join my free user community over at school.com/simpleoptiontrading. I'll leave a link in the description down below. Well, there you have it. I just sold a covered call for an ETF AAPU. I walked you through all the steps in my process. I took a look at the profitability. We read the charts to make sure that the proper criteria is being met in the right situation. I walked you through the steps of actually submitting the order. And then you can see where my option contract actually got sold. If you like this video, be sure you leave a comment down below and give me a thumbs up. I really appreciate all the time you spent with me. I look forward to seeing you in my next video.